Hello student, welcome back to IBS. Today we are going to discuss about income statement overview, balance sheet statement overview we have already done, and we have learned in depth and in detail each and every line item of balance sheet and their meaning and their uses. So now we are going to learn income statement, and that is very detailed and I hope you will enjoy it. So let's jump to the topic. First we are going to understand about the income statement, how it is and how it looks alike. So first understand about the purpose of income statement. The purpose of income statement is for financial performance over a specific period between two periods from January to 30 Jan, maybe the period, or maybe 1st Jan to 31st Jan 2024 or 2023, whatever it is. So maybe any period between two period we want to know the financial performance, so we will check income statement. If you want to know financial performance as of a specific date, as of one date, for that you will use balance sheet. And for the difference between two periods with regard to financial performance, you have to see into the income statement. What they are showing: revenue expense result in net income or loss. What is the result after all the activity we perform during the period? So whether we have generated any income or we have not generated, so that will be reflected in income statement, and it helps to user to forecast the future cash flow, how much in future we are going to generate cash. That we will learn through income statement by seeing 5-6 year of financial statement. If we are seeing earlier they were having 8,000 net income, then 85, then 88, then 9500, then again it has jumped to 11,000. So like this, if they are growing, and now they are 12,000, around 13,000. So we can see this kind of pattern. Based on this, we'll see the difference from initial year 0 to year 5 or 6, whatever, year 1, year 2, year 3, year 4, year 5, year 6 where we have reached, and year 1, year 0 where we have started. So what percentage we are going, based on that we will able to calculate what would be our future cash flow. So this is all about the income statement. Now we will discuss about the feature of income statement. That feature create a difference between income statement and balance sheet. What exactly the difference? These are temporary account like revenue, expense, gain and losses. These all are temporary account. Whatever amount is coming into this GL, that amount will be nullified to zero in next year. Whenever the next year will start, in every beginning of the year, the value of GL would be zero. So whatever entry is being posted, that will be removed. So that is why this is called temporary account and close with to return earning. So whatever amount you are seeing here, that amount is going to close by this. So this amount will go to your balance sheet. Let me make the balance sheet, asset side, and liability and equity side. Asset side, your current asset, okay, and fixed asset kind of stuff, and liability, current liability, long term liability. Then equity, in equity you will have a lot of things like treasury bond, like return earning, reserve and surplus kind of stuff. In return earning, this will go. So what you will do, that for passing this entry, you will, this is credit amount, okay, this is minus amount actually. So you will debit this and you will credit the return earning. So return earning will increase. So then your asset and liability, everything will nullify. So that is why you don't need to pass such kind of entry in ERP. This is already linked. So whatever amount it is coming, it will be keep on increasing your revenue. If you pass one single entry, if you increase this by 5,000, so maybe here it will increase by 5,000. So there your return earning will also increase by 5,000. This is all linked together. That is why they are saying this temporary account will close to return earning. So they are trying to say at the end of the period, so when we have finalized our net income, then that amount will come to your return earning, and then the next period, day one, your all balance of this all are would be zero. I hope it is clear to you. An income statement, how, which method we follow? We follow accrual accounting method. Record revenue and expense when they incurred or earned. When we have earned, we will record our revenue. When we have incurred expense, we will try to account those kind of expense entry when incurred. It doesn't mean whether we have paid or not, that is separate. Payment is separate part, but if we have consumed the benefit, then we have to book those kind of entries. I think it is the overall explanation with regard to income statement. Now we will try to understand the structure of income statement. What are the items are available in income statement? So first of all, you will see that there is a revenue. So you will have all the entire period, from one period to another period, whatever revenue you have recognized, those amount will come here. Then after just revenue, you will get your cost of goods. In cost of goods, you will have cost of your inventory or material or finished good, everything. So overall the cost, for example, you are selling product, maybe tea bag, for that you are charging $100, and cost to purchase this or made this, whatever it is, either you purchase it or you made it in your factory, maybe your cost is $70. So after that will be your cost of goods sold. So this is the definition of cost of goods. I hope it is clear to you. Then if you remove your cost of goods, this will be reduced, then you will get your gross profit. So similarly, you are getting your gross profit, and from gross profit, if you remove all your selling and administrative related expense, that is again related to your revenue, how much revenue you have recognized, similar amount of your selling expense you have to add into that P&L or income statement. Because in marketing, you may invested $10 million, okay, for your 5-year plan or something, but then the agency you have paid to agency, you have paid this much amount for 5 years, but he has worked for 1 year till now, so only 10 million divided by 5 to 2 million you can charge here. You cannot charge entire 10 million because he has not given the complete service. So based on revenue and based on sales, if it is directly linked with your sales, for example, in education industry, if you have issued a coupon for two person called Ram, and coupon code is XXX. So whenever he sells every product $5 or maybe $50, whatever it is. So whenever he is selling, you are giving him discount, and he is, whenever somebody purchase through his reference, he will use this code. So that number of quantity is being sold by this person, which will reflect into that company that you have sold hundreds of products. So based on that, you are being given discount, and he might charge for every product. If he charge $1, since he sold hundreds of products, so we generated revenue 100 into 50,000, and we will pay 100 into $100 we will pay him for marketing. So this marketing cost is directly related with number of quantity. How many quantity you sold, the same amount you will charge here into your selling and administrative cost. I hope it is clear to you. And you will have your administrative related expenses like office expense, salary to your direct staff who is supporting to this business or operation, like manager kind of stuff, and your rent, utility, everything will be reduced here. And then after reducing that, you will get your EBITDA, earning before interest, tax, and depreciation and amortization. Depreciation is coming after this, interest expense is coming, and income tax is also coming, and depreciation I have already spoken, and interest and tax. So earning before interest, tax, depreciation, and amortization. So everything before all this expense, whatever your profit is coming, that will be your EBITDA. So from selling and general and administrative expense, if we reduce, we will get our EBITDA. And from EBITDA, if you reduce your depreciation cost, this is non-cash expense. That is why EBITDA, normally company try to know what is our core earning without even touching any non-cash. Anything which is coming is all our actual expenses. So for that particular period, in this period, this is your actual revenue, this is your actual cost, and these are your actual expense. There is nothing which is non-cash, or even though if you have booked some of the utility and water based on accrual, but that accrual is belong to this period cost only. Whether you have received invoice or not, that is separate. So whether you have paid or not, but since you have this cost is belongs to this period, so all those actual costs will be considered. Then you are generating your net profit, that is your EBIT. So that is why EBITDA is very important in case of merger and acquisition and due diligence, and even enterprise value is being calculated, company value, if you are going to sold your business or something. So that time this EBITDA is very much important. Then we have non-cash item, depreciation and other stuff, amortization. If we remove, then we will get our operating income. This is nothing but EBIT, earning before interest and tax. Before interest and tax, from operating income we will reduce interest expense and dividend, if we have declared any dividend, and declare even though you paid or not. since it is declared to this period, so that accrual concept it will be debited. So interest income, this is income part, that is why you might see I am giving plus symbol. For all the expenses I am giving minus symbol, because this will be removed from your revenue. This one also minus, you can see. Cost of goods sold is also in minus, so like this. Then after reducing your expense and interest income and dividend, you will have non-operating related gain and loss. In case you sold any asset or something, for those losses or gain you will keep in your income statement. So after considering all these three items from operating income, you will minus your interest expense, interest income and dividend income. If you dividend income or maybe dividend expense also you can minus. Dividend income something like, for example, you have invested somewhere, from investment those companies paying you dividends, so that will be your dividend income. When you are paying, that will be your dividend expense. All your interest expense, dividend expense, interest income, dividend income, all you will, I mean to say, add. Income related stuff you will add, and loss related stuff you will reduce. And then non-operating gain from your investment or something other kind of income you receive. Then after you will get EBT, earning before tax, or that is also called income from continue operation before income tax. Now you will reduce your, based on your provision, based on your historical data, whatever you think this would be our income, this is our income. This is not forecasted item, this is actual. So based on your actual amount, you will, based on your income tax rate, you will calculate your income tax that you will reduce, and after that you will get income from continue operation. So this income is your from continue operation. Then you will reduce your gain or loss from operating of this continue component, but that to net applicable tax. If you have received or lost something like 10k and their tax rate is 25, so you will book here around 75 only. You will reduce the tax part. Net of tax will be coming here, because we have already calculated our tax here. So that 2500 will be added to this tax separately, but you don't need to show here because you have already calculated your income tax. Now just other than this normal business, if you are having other gain or loss, based on that whatever your tax is coming, that you will add or reduce to your main tax. Okay, so maybe 5310 is your tax, and then after selling, if you receive any gain and you are paying tax on that, whatever the percentage is applicable to that company, maybe 2500 that you will add. And there is disposal of discontinued component, so maybe there you get any loss for 10,000, and again for 10,000 you will get benefit of tax deduction of 25,000, that you will minus here 2500. So after this impact, since this is the same amount, so impact would be 0, then 5310 would be your payable. There is difference is coming, so that you have to add. So if you don't have any loss or something with regard to tax, then you will add both of them. Like this we normally work. Okay, then you have extraordinary gain, any other gain, we will be adding or reducing accordingly. I hope it is clear to you. This is just a sample of income statement. So I think I'm done for the day. We'll see you into the next session. Thank you very much. Stay tuned.